Welcome to Stolen, the world's greatest eminent domain podcast. Legally, the government has the power to take your property, but most people don't know what to do when it actually happens. If you don't respond correctly, you could walk away with far less than you're owed. And when that happens, in effect, the government steals your property. Our mission is simple: protect property owners, make sure they get the compensation they deserve. The government will steal your property, but only if you let them. Hey, welcome to Stolen, the world's greatest eminent domain podcast. I'm Chad Brown. I'm your host, and we are here once again talking about issues that affect property owners in eminent domain, land condemnation cases. I'm with my trusty sidekick, Robin to my Batman. That's right.
Laverne, Shirley. Shirley to your Laverne.
Real estate, property, extraordinaire. Sorry. Lawyer.
Thank you.
Singer. They're going to have you. Caleb.
No. Hey, thank you for having me, Chad. Appreciate it. It's good to be here.
We're going to talk about something really important today.
We are
In residential cases, we're going to talk today about mortgages and how mortgages are impacted in eminent domain cases. We're really just going to focus on residential today. I mean, theoretically, you could have debt on commercial property, and these issues could come up there too, but usually those are very different type scenarios. We're talking about just straight partial or full taking, single family homes, DOTs widening the road, taking your driveway, taking your bird feeder, crushing your well.
Oh my!
You got your lawn at BB and whatever.
Yeah, BB and whatever nowadays.
Yeah.
Truist.
Yeah, Truist.
First Horizon. I like First Horizon. They're my baby. Yeah. Jobs First Horizon. St. Louis Credit Union.
Fifth Third.
No.
Fifth Third. I don't understand that.
I don't either, but it's whatever.
Like they're better than 100%.
I don't know. The math is math in there. So, anyways,
I think the thing to do though is that let's back up and talk a little bit about mortgages generally.
Yeah.
Let's start there.
Okay.
Because I think it's important to understand just basically how mortgages operate and work. Because if you don't understand that, then sometimes you can be confused about what's going to happen in the main case. So what is a mortgage?
So a lot of people just, they kind of chalk it up to the bank loaning somebody money to buy a property, and that's about it. Yeah, but really, it's a lot more to it than just the bank loaning somebody money. If you have bought a house, and understand that there's more to it than that as well. The mortgage is simply the bank giving, or not giving, but loaning a person money to buy a property, and the bank then takes a security interest in the property once they've loaned the money.
So they have a lien.
They have a lien, so the bank has a lien on the property, which is filed at the Register of Deeds office, and so it's public record at that point.
So inside that mortgage, there's going to be a ton of documents.
Yes.
They're going to hit all kinds of issues, things like repayment, interest, escrow, taxes, insurance,
amortization schedules, sometimes
particular schedules, acceleration clauses. What happens if you sell the property? What happens? There's eminent domain or condemnation action on your property. But just as a base level understanding, mortgage is simply a loan used to buy real estate.
That's right. And for the loan to go through, a lot of times the bank, as most people know, the bank will have to send out an appraiser to appraise the property.
Right.
Okay. If the goal of that appraisal is that the appraisal will come back with the land value, the property value being equal to, if not greater than, the sell amount, the loan amount.
Right.
Okay. So if it comes back more than the contracted amount for the property, the sell amount, great, you got equity in your home now. Automatically, you got some equity. But if it comes out lower, sometimes we have to see a retooling of the sales contract.
So inside a mortgage specifically, though, each party has rights. So now we're in a contractual relationship with the bank. The homeowner has rights. The bank has rights, or the lender, or whoever. Sure. Mortgage company, whoever, I mean, it could be seller finance as far as that goes, but let's just stick with banks as a lender. What are the property owner's rights?
Property owner's rights, generally, you have the right to habitability. So you can go and you can live there on the property. You still have the ability to do all that. You have the property to do basically whenever you want to the property, except harm the bank's interest in that property.
Yeah, so you can sell it.
You can sell the property. You can alienate the property, i.e., sell the property. But that does come with an issue, Chad. And that is usually when you try to sell a property and you have a lien on it, a bank has a loan on it. You have to pay back that loan if you sell the entire property.
Yeah, okay, we get all that. I just
Yeah.
want to talk about what the individual's rights are.
Yeah.
Because I think that sets a better framework for where we are for eminent domain.
Sure.
So the bank has rights too. The lender has rights. So what are the lender's rights?
So the lender has a right to be paid back the loan amount.
Okay.
And so if they don't, then they have the ability to foreclose on the property to make sure they protect their interest on the loan.
Well, they can also do things like require you to have insurance.
They can require to have homeowners insurance. They can require to pay escrows, right? So property taxes, homeowners insurance, all those things go into escrows.
So they want their money up front.
They want their money up.
They want to make sure you're going to
Protect their
they're not going to default on your tax obligation.
Yeah, and as a matter
or
of
not pay your insurance, and then the house burned down, and their interest is gone.
a lot of times they'll collect a couple months in advance at the closing so they can have that buffer of protection on the insurance, homeowners insurance, and the taxes in case there is a foreclosure or default on the loan. They would have time.
And in reality is the majority of residential property owners that we engage in eminent domain matters or condemnation actions, they have a mortgage on the property.
They usually have
of some level. It may not be 90%, but they have a mortgage. Sometimes they have multiple mortgages. They might have a first mortgage and then have a home equity line of credit, HELOC. So what is the security? What is the concept of security interest? What does that mean?
Security interest is basically when the property has a lien on it, they take a security interest, i.e., it's a protective mechanism for the bank's loan towards your property. So if they give you money, they're essentially protected in case that you default. They can always repossess the property, sell it, so that their interests are protected financially.
So in a typical residential mortgage, the property collateral is serving as security for the note.
That's right.
Okay. So what about transferring the property? Does the bank have any say at all over if you can transfer the property?
Generally, the bank doesn't have a say over with whether or not you can, but the bank can require that you pay off the note with the proceeds of the sale if you sell the property.
So due on sale clauses,
Pretty common.
Pretty common in that. Okay. So you have your home, Uncle Charlie at the bank got you a loan. Sure. You've been there 4 years and you've paid almost no principal and almost all interest because that's the way amortization schedules were. Yeah. And here comes good old Uncle Sam.
Yep.
He's coming in. He's going to widen the road because you moved to this really fast growing area and a bunch of people complained and they come and they take a big part of your front of your house property, not the house itself. They took your driveway. They took the culvert. They took Johnny Swing set down. They got the beautiful apple tree that you bought the house for so you could see your kids going out and picking apples and swinging and they just took it.
They just took it all.
They didn't care. They just come and took it and said the road has to be wide. Okay, how's that? What's happening? What sort of issues are you going to be facing because you have a mortgage on your property?
Okay, so it's a couple issues. Again, the scenario that you described is what we would classify a partial taking.
Okay,
that's a partial taking.
Sure.
If there's a partial taking on your property, first thing that I'm going to look at through my perspective as the attorney. First off, we're going to look at how much. You described a pretty large parcel of your property being taken.
Yeah, sure.
Okay, so next thing we'll look at is how much money is still owed on the mortgage. Okay, that's going to be a big part.
But we're going to start with just like any other case. We got to look at just compensation. We got to figure out the fair market value before and after.
Obviously, we got to do the fair market value analysis. Look at comparable sales. Then get an appraiser involved.
The fact you have a mortgage on your property has no impact on the valuation.
Absolutely no. Well, that's a two-edged sword, right? Double-edged sword. Because also, just because you have a loan on your property doesn't mean that the state has to give you compensation to the level that the bank is going to require. right? It doesn't mean you're going to be compensated fairly.
All I'm saying is in valuing the property, the fact that you have a mortgage on it doesn't bring the value down.
Oh, no. There's no indication. If you have a mortgage on your property, that's not in any scenario really is that going to hurt the value of the overall valuation of your property in the context of fair market value.
Okay, so we've got, let's just use some real simple numbers. Okay, we bought this beautiful home with a beautiful apple tree, and we bought it for let's just use simple. It was a $750,000 home. Okay. We put down $250,000. Okay. So we've got a loan for $500,000. Let's just say that's $500,000. We really have 500 G's, and we've got a sort of a rough determination that there's a 10% impact on the value of your property, so that now we have a $75,000 impact. Yeah. So we believe that the devaluation of the property is down $75,000. You still owe $500,000. Now it's when the fun begins, right? Yeah, we get our job. We went in there. We fought. They offered you $12 to start with. And we said no. It's $100,000. They said $15, and we went back and forth and got them to $75,000. Now it's when the fun begins.
The attorney or the person representing themselves, or whatever, they can reach out to the bank that holds the note and report that to them, and then the bank will either require somebody to pay on the principal, okay, right, or nothing at all. It depends on how much, again, it's affecting the overall scenario. Now, this scenario that you're talking about, it might be feasible that the bank will require a little something since they haven't paid much on the principal balance at all.
But the principal interest that the issue that you're dealing with, in this scenario, partial taking, is that there's going to be money that comes to you, but you owe the bank money. So why does the bank care that you get some money?
Yeah, so essentially you're losing property.
Okay.
That property is part of the collateral.
Okay.
And so if you're losing part of your collateral, their interest in the property is therefore decreasing. Their collateral in the property is decreasing.
So that security interest so we went through all of this, and with the appraisal you talked about, the appraiser came back and said, this is a $750,000 home. And the bank said, that's great, because we're only going to loan $500,000. But it's based on that property, all 100% of that, the apple tree.
That's right.
Even
all that.
The apple tree. And
all that
improvements run and the swing. Maybe not the swing, but maybe not. The stuff that was there.
The stuff that was there.
And they took it.
That's right. So it's taken out, therefore decreasing the property's overall value.
Because we said it was a 10%, so now your property's, it's only 90% of what it was before the DOT did their thing.
Yes, exactly right. So it's 90% of the total value that was before.
Right.
And so now that because it's been decreased by that 10%, the bank's overall collateral interest, the security interest in that property has now been decreased, and the bank's interest has to be protected. And so by doing that, to protect their interest, they'll sometimes require in the mortgage instrument itself, North Carolina, we call them deeds of trust, other states, mortgages, they require that some of that balance of some of the settlement award be applied to the principal of the loan. Okay.
So, but just to help people understand mathematically what's happening is you had a $750,000 house, and now you've agreed that it's really only worth $675,000 because you have $75,000 impact on the property. The future growth and appreciation aside, but after the taking, they determined it was worth $675,000. So from the bank's position, the lender's position, now we still have $500,000 outstanding, but it's on a property now that's only valued at $675,000. So I'm not great with math. It's going to be a disaster. Let's say that they required a third down, and that's how you got to the $500,750. And they said, hey, we think you're only, based on your income and all those issues, we think that we need a third protection of the properties. And now you go and about 675 by a third, and you get 225. You need 225 or 675, and you get 450, and you owe 500. And so the bank's looking at it going, well, I wouldn't have lent you $500,000 on a $675,000 property. I would have only lent you $450,000.
Yeah.
So this is oversimplified, and there's a lot of factors, but to help the property owner understand, because you gave up your property as collateral, because you're using it as a security interest, you can't stop the government from taking your property.
Right.
But when they take it, you have less property, and that property is the collateral. Their collateral's been impacted. Their security interest is not the same as it was when you started. And so now we got to figure out what to do.
Yeah. So in your example, the bank might very well require that some 50 of that $75,000 be applied to that to get it to the ratio that they look at their needing because of your credit history or whatever. However, I will say this, and it's not quite that simple in reality, because these deed of trust, these mortgage instruments, a lot of times will have a formula that's actually laid out in those mortgage instruments. Instrument being the document that holds your mortgage and is filed with the register of deeds. Those documents oftentimes will have a formula in them if it's a partial taking, which allows you to calculate roughly what the just compensation would be for the bank. Now,
so let's talk to that. Let's talk about resolutions to this. So we've gone through. You have a property with a mortgage on it. You settled your eminent domain case. Mm-hmm. You're excited because you're going to get some money. And Caleb had to throw the stop sign up and say, hold up a minute. You don't know how much this you're going to get. Right. One way we have to resolve that issue. The property owner has to do it. If we're representing someone, we have to do it. So one of the ways that could be resolved is it could be resolved by the mortgage documents themselves that actually lay out how property distributions related to how compensation received by the property owner in the condemnation action or eminent domain case, how that has to be applied to, if it has to be applied to at all, to the loan, right? So one way it could be resolved is simply by the terms of your agreement with the bank.
Exactly. Okay.
Sometimes they make you pay it all.
Sometimes they'll make you, sometimes you have to. It just depends on how much property they're being taken. And usually it kind of relates to loan to value, right? Sure. So loan to value ratio, it relates to how much the property is being taken. So when you compare the loan to value with the proportionality of the property being taken,
right,
that sometimes that formula could equal you give all of it.
And then sometimes, I know other times we've had cases where the bank just, we don't care.
Yeah, we've had cases where the bank just said we don't care.
We're way over secured. Exactly. We've got a $250,000 loan on an $800,000 property. We don't care when $50,000 goes. Doesn't make any difference to us.
And that's a reasonable response from a bank. And I will say this is a cautionary tale or precaution to people who have Fannie Mae backed loans or things like that. There's going to be a whole different set of rules with these Fannie Mae loans. You can literally on Google the Fannie Mae rule book, and they have eminent domain context in there that you can look at that banks will be bound to if they're secured on the Fannie Mae.
So at that point, it's not the banks.
No, it's not the bank.
That bank doesn't have a say in what you just being driven by federal.
They're a middleman at that point. I will say this too, Chad, just another precaution homeowners should take, and that is sometimes it's good to start on these processes as soon as possible, because with certain banks, like I'm not going to say your names of banks, but there are some banks. Yeah, we're not going to do that. But some banks,
we're only positive here.
Only positive ever,
unless it's about
unless it's the government. Anyways, so when it comes to some of these banks, it's good to start process early because they'll have certain documents, forms that you'll have to get filled out. And you'll have to get these in processing. Sometimes it takes 30 days to process these. This is a practical matter.
Sure. I think one of the things that people need to understand too is you need to appreciate too, if you get a reasonably large settlement and all of that money goes to the bank, it's perfectly reasonable to go to the bank and say, can I refinance my loan? A lot of people don't know also you can do what's called recasting, where you can recast your loan and basically say, look, I owed you $500,000 in principal. Now I only owe you $400,000 in principal. I want you to take account for that large principal payment that's been made so that I'm not asking you to change the terms of my loan. I'm asking you to change the payment.
That's exactly right. Reamortization based on the new principal balance.
Yeah, and that could be really helpful though, because you've lost some value in your property. But if you can gain some cash flow back out of that by restructuring how your loan is, then you may be able to take that, invest it, or do whatever you want to do with it.
And let me just take a moment here to just kind of define some things. So refinancing is if you refinance a loan on a home, you're basically getting a whole new loan.
Yeah, correct.
You're basically getting a whole new loan. You're getting a new interest rate. new amortization schedule with new terms. Your also with the recast, that's not a rewriting of the terms and interest rate of the loan. That is simply, usually you're staying with the same bank when you recast.
Oh yeah.
With the refi, it could be a whole different bank.
Yeah.
I mean, you could be going from Truist to Bank of America, just to use two big name brands here. And so with like I said, a recast, same bank typically. So just want to make sure people understand that, and that these are options available to you after an eminent domain project case or whatever.
Sure.
These are options that are available to homeowners to ensure that their monthly payments are getting down, because that's what people really look at. I mean, if we're being honest here, most Americans are concerned about that monthly outgoing rather than the overall.
Yeah. Sometimes you can, the client will be upset that they weren't able to take that money, which they view as theirs.
Sure.
But at the same time, you're able to go to and say, hey, well, okay, maybe there's a silver lining here. Maybe there's a way we can recast the loan or restructure the loan and work with your bank to do that. And for several $100s, you might reduce your payment, $1,000 a month.
$1,000, yeah.
Okay. I think big takeaways, though, would be if you have a mortgage on your home, you need to understand this is not as simple as settling your case and getting a check. That doesn't necessarily be that you won't get the check. Doesn't necessarily mean you'll end up in maybe a worse scenario, but the bank is going to take any impact to their security, which is your property, very seriously. And usually there are specific terms already in place that address this, even if you didn't read them in your loan closing hearing. Likely you probably didn't. So start early, be aware of that, get the documents, make sure you can't hide from this issue, because at the end of the day, over certain amounts, the DOT won't even release the money to them back.
That's exactly right. And I just want to make one thing very, very clear to people who are suffering from this. And that is, if your entire property is being taken and the DOT is offering, enough that's, going to pay the loan off, but it's not really going to be enough. Maybe you're in a suffering real estate market or whatever. There's also something called relocation expenses that are not part of the just compensation. So the relocation, and most states have relocation assistance in their state laws that have been passed by their state, governing bodies. And so these relocation assistance programs will help you relocate a house and help you move. There's moving expenses. So they've given you enough to pay off the loan. And so you basically start from square one, but you still get some help moving to this new house. Even though you don't have enough to pay for the new house because you're paying off your loan, well, you can still qualify for the loan, presumably, and move into this other house, but you get the moving expenses paid for. Right?
Yep. All right. That's all the time we have. Another episode Stolen into Books. Subscribe to our channel. This is the greatest eminent domain podcast in the world.
It is the absolute greatest.
It is the greatest, and we want you to watch and listen. Till next time, take care.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.